diversified mutual funds in the country. Raunak, afternoon. Thanks for your time. Raunak, what is the market penciling in? I mean, Nilkant in his note today said that high probability that India CPI peaked out with yesterday reading of 7.4. What is the view on US CPI? Do you see market bracing in the end of the rate hike cycle, assuming that we are almost at the fag end of the peak inflation readings or not yet?
Thank you, Ajay, for having me on the show. Actually, it's very hard to predict. So month on month, we keep getting the inflation numbers. And the interesting thing about inflation numbers is if you now fast forward to another year, this year's inflation numbers will be next year's base. So we have to think from that point of view whether the inflation cycle continues over a longer period of time. And for that, I think when you go by company, sector by sector, the inflation metrics really affect different businesses differently, different sectors differently. So instead of looking at the headline numbers and obsessing over too much, because every month there will be a new headline number coming in, and just like the investors are reacting to that information, even businesses will have to react to that information in real time. So I don't think I have any predictive answers or abilities to guess what the US CPI number is going to be.
Okay, fair point. No, I was wondering if there are any indicators that you're keeping an eye out for. That's fine. Let's talk about the view on valuations. The fear is that if borrowing costs and rates continue to head higher, they will impact the earnings visibility and the earnings trajectory of companies the world over, and hence the current valuation look expensive, and hence the stock need to go down. At least US has faced that quite a lot. Do you see that scope in India as well, or you see the resilience in Indian market due to the resilience of underlying earnings?
So if you see commodity sectors, we have not seen too much of a correction there. However, if you see traditional businesses who had a longer term earning cycle, those businesses have already, I think the prices have already corrected in many of the areas. Services business or even other areas, prices have corrected. So on the interest rate cycle, yes, definitely as the interest rate cycle is on an upswing, we will see valuations getting depressed across the board, because it will be incrementally harder to raise money. It will be incrementally difficult to do M&A by having leverage. So all those factors which would have caused earnings growth in the longer run, those factors will be muted because of the cost of borrowing going up. So I think definitely the valuations have to be suppressed, but I think in many cases the valuations have already corrected. They may not be in a very attractive range, but they are still corrected from what they were at peak.
The reason I'm coming back to valuations is because you guys have been tracking US market valuations for the longest time. I think maybe the first mutual fund to actually start investing in US markets. After 30% fall from top, what is your view on the valuations in US market to start with? Till last 2 years, everybody was crazy to invest. Now nobody wants to invest when the prices are down 30%.
In fact, it depends on the businesses you want to invest in. So if you know that the business that you're investing in has a longer term trajectory and the growth might be affected here and there, that's for sure. Cyclicality is bound to happen. But if the business still has the longer term metrics in place and the business model is sound and they don't need outside capital to grow, I think the valuations are looking far attractive for those kind of businesses. When you've seen correction in many of the sectors, I think the biggest corrections have happened in areas where the businesses don't have a capital generation business model. So they don't generate their own cash flow, which can fund their future growth. Many of these companies were dependent on external funding or external capital raise through equity dilution. That cycle has actually come to an end. And those businesses will definitely get hampered in their growth stage if they are not able to use internal cash flow to grow. So I think those cases we have seen valuations crash quite substantially. But the other cases where the companies don't need to rely on capital markets to raise funds, I think those companies' valuations have become very attractive. And given a chance, if the RBI mandate wouldn't have been there, we would have definitely added to our positions as well.
That's an interesting point. Okay, Raunak, let's talk about India. Which are the areas you have been biggest buyers in the last 6 months as far as Indian market is concerned, where you think earnings could surprise next 2 years, and valuations are still not pricing in big earnings recovery?
The window of next 2 years is difficult to predict from earnings surprise point of view. We have to wait and watch and see how the numbers evolve. But the areas where we have been actively buying in our portfolio has been on private sector banks, where the three private sector banks we own. In fact, HDFC Bank we shifted to HDFC Limited because of the merger announcement. But ICICI Bank and Axis Bank remain part of our portfolio. We've also been adding to our IT services holdings and pharma holdings periodically. And wherever given a chance in capital market businesses where they are non-lending businesses, those businesses we have added in the fund.
Oh, that's an interesting one. Are you buying AMCs, tech-backed brokerages, areas like that?
So only AMC
or even platforms and exchanges kind of business?
Yes, so we do have MCX, IEX, CDSL in our portfolio. We also have Motilal Oswal, which we have been adding over a period of time. That is the only AMC we own directly. The other business that we own, like if you own ICICI Bank, you end up owning the underlying subsidiary AMC business as well. So in that way, we own through residual shareholding in this company.
Yeah. Raunak, on pharma, I'd like to get your opinion. There is the US facing generic exporters which are facing pricing issues. Then there is branded guys in the domestic market where valuations are better, margins are better, more predictability, and the 50-year plus. Somebody was just telling me that the 50-year plus population in India is 27 crore, which is equal to some of the large countries. Just that we never look at it in absolute terms, we look at it percentage. So we keep on saying 1/3 of countries are under 35, but over 50 is 27 crores. So they get a lot of business from branded formulation and companies here in India. So how are you looking at this pharma piece?
So in pharma piece, what we have done is over the past few years, we're noticing that it's becoming incredibly hard to predict which one single pharma company can consistently do well. And there are several reasons for that. So many companies which are exposed to the US generic business, they have been also facing the US FDA sanctions in order to get their quality of their manufacturing up over a period of time. And because of that, it affects their export revenue over a period of time. On the other hand, same businesses which are large diversified generic pharma businesses, they also have a very strong branded generics business in India, which you rightly pointed out. India is a very good market for some of these pharma businesses. And if you see the last 5-year data, these companies have been consistently growing the India piece step by step over a period of time. In fact, if you compare the US and the India business, the rate of growth is much faster for some of these India focused businesses. So India definitely is a key market for all these players. The interesting part is for the global generics business, some of these companies might be end-to-end integrated by creating their own API and formulations and exporting, because the gross margins outside the country are much higher. Whereas in India, some of these countries will have to depend on lower cost API or drug intermediates from other neighboring countries where they have to import these substitutes. And those might face some pricing pressure because of the raw material and supply chain disruptions that these companies have faced. But I think those will also lap over a period of time. The average gross margins of all these businesses have been in the healthy range of 55% plus. I think that is the number most companies aim at to stay. And as long as the US business is continuing and they keep on reinvesting in newer areas, and as the drug comes off patent from some of the innovative drug manufacturers, they come off patent, some of the generic companies who have the capacity and have the R&D done, they will be able to launch generic variants of them in the global markets as well. But that's the reason we built a basket of pharma companies who share these characteristics rather than buying one single company and then betting all the funds on that one business.
Right. All right, Raunak, thanks very much for joining us on the show today. That was Raunak Onkar of PPFAS Mutual Fund.